So we'll continue the discussion on Basel regulations and see how the calculation for operational risk charge is done. So just to refresh, operational risk is defined as the risk of loss from inadequate or failed internal processes, people, systems, and or from external events. So we discussed earlier, examples include legal risks, physical assets damaged, business interruption, so on and so forth. Please remember, and may be tested, reputational risk or loss of reputation and strategic errors, that is a failed merger or a wrong capital call, etc., are not examples of operational risk. Idea here to understand how Basel II, that brought in operational risk for the first time, or brought in a charge for operational risk for the first time, how does Basel II mandate the requirements for operational risk charges? So the first approach is the basic indicator approach, to be used by unsophisticated banks and simple banks wherein not much computation needs to be done. So the BIA approach simply says that 15% of the bank's average annual gross income over the previous 3 years should be kept out, or should be kept as a operational risk capital charge. So if you don't want to follow the other advanced approaches, as we will see, then you as a bank can simply follow the basic indicator approach. The only problem is that if you are a good bank and you actually have operational risk control measures in place and your risk is much lower than this, you would still have to keep a 15% of the average annual gross income over the last 3 years as a capital charge using the basic indicator approach. Standardized approach can be used for banks that are able to demonstrate a level of sophistication in their risk management and risk calculation procedures. So herein, the capital charge for each of the 8 business lines, namely corporate finance, trading and sales, retail banking, commercial banking, payment and settlement, agency, asset management, and retail brokerage, is calculated separately against the average annual gross income for the business line. So for corporate finance, we need 18% of the average income, for trading and sales 18%, so on and so forth. For the other business lines of the bank, a prescribed percentage of the last 3 years average income is taken as the capital charge. The advanced measurement approach can be used by banks that have a significantly advanced and developed risk management system. So you have to convince the regulators that you are actually able to compute the unexpected loss, as we discussed, or the operational war on your own, and you have enough data and enough validation of your models done so as to be able to use this approach. So here the risk charge is calculated on basis of internal operational risk management systems approved by the national regulator. We'll study each of these approaches in more detail. So the basic indicator approach, again, a fixed percentage of the bank's average gross income over the previous 3 years has to be kept as an operational charge. The average annual gross income is defined as the net interest income plus the net non-interest income. So it's the fee income also that is included in the calculation of the gross income. The multiplier percentage, that is this alpha, is currently set at 15%. And the issue, as we discussed, is that it ignores quality controls and is mainly for use by non-sophisticated banks. So if you have good controls and you're able to demonstrate that, then you may need to keep a lower capital charge, and you may want to follow some of the other approaches or the more advanced approaches that we have seen. In the standardized approach, the capital charge for each of the business lines is calculated against average annual gross income for the business line times a factor called beta, which is mentioned specifically for each of the business lines, as we saw. The calculation is pretty similar. So the total capital charge is the 3-year average of the simple summation of the regulatory capital charges across the business lines in each year. So for the last 3 years, every year we would calculate 18% of CorpFin's income, then we'll do 18% of Corp Finance Department's income 2 years back, and then 18% of the income 3 years back, and then take an average of those three values, and that will be the average, the capital charge corresponding to corporate finance. Similarly, for all the other business lines, will give us our total capital operational or total operational charge for the bank. In the advanced measurement approach, the bank is allowed to do the unexpected loss calculation on its own. So we studied the loss distribution approach in operational risk, where we saw that the bank can collect the loss data, have an expected loss, have a 95% loss or a 5% war loss. The difference between this is referred to as the unexpected loss. So in the advanced measurement approach, the banks can specifically calculate this unexpected loss and keep that amount as a capital buffer. So it's calculated on the basis of internal operational risk management system approved by the national regulator again. So various approaches can be used by the banks. So don't need to know the details of these approaches. The internal measurement approach can be used. The loss distribution approach can be used. So this is what we detailed in the operational risk review, wherein the severity distribution and the frequency distribution is specifically modeled. A scorecard based approach can also be used. So this approach basically conditions for the current time periods. So if the risk indicators are high, then maybe we'll keep a higher risk charge. If the risk indicators are low, we'll keep a lower risk charge. So never mind the details of the approaches, just know that the advanced measurement approach allows the bank to use its own internal calculations for the risk capital charge or the operational risk charge. For using the basic indicator approach, you basically don't require any sophistication. It can be adopted by any bank, regardless of the complexity and sophistication. You still, however, need to comply with the sound practices guidance document that every bank needs to apply or comply with. Again, you don't need to know the details of this document. This document basically contains some best practices and the best way to go about business and to minimize operational risk. If you want to use the standardized approach, then again you'll have to comply with the sound practices guidance document. You'll have to demonstrate an independence risk control and audit function, effective risk reporting systems, clear responsibilities assigned for operational risk management. Demonstrate that the board of directors and senior managers are actively involved in the oversight of operational risk. Have a system that is robust and implemented with integrity. And you must have sufficient resources, manpower, and other requirements so as to conduct audit and conduct effective risk management. For using the advanced measurement approach, even more precise quantitative and qualitative entry standards are necessary. So AMA is subject to a phase of preliminary monitoring by the supervisor first. So you monitor the operational risk governance, the risk loss data, risk quantification, and risk mitigation techniques, and how you have incorporated those in your model or in the calculation of the operational risk charge. Other quantitative criteria is that banks must track internal loss data for a minimum period of 5 years. They must use external data as well. They must use scenario analysis to evaluate the exposure to high severity events. So these are normally low frequency, but still you must conduct a thorough scenario analysis as we studied. Banks must take into account the business environment and the internal control factors. So the risk measure and the risk charge may need to be conditioned for the business environment. So we must make sure that the bank's models are effectively capturing that. Especially in bad times or in stress times, we've seen that liquidity can become particularly low. So you should keep extra capital in situations like these. Insurance can be used to offset up to 20% of the operational risk charge, not more than that. So you can't say that I've purchased insurance against all operational risks, so I won't keep any operational risk charge. Which of the following statements about its methodology for calculating an operational risk capital charge in Basel II is correct? Basic indicator approach is suitable for institutions with sophisticated operational risk profile. That's incorrect. Under the standardized approach, capital requirement is measured for each of the business line. That is correct. Advanced measurement approach will not allow an institution to adopt its own method. That's wrong. And advanced measurement approach is less risk sensitive is also wrong. It is the most risk sensitive approach. So higher the risk, the more the capital charge. Lower the risk, lower the capital charge, because here we granularly model the risk and then keep a buffer or a capital charge. According to the Basel Committee, which of the options below is not a quantitative standard that a bank must meet before it is permitted to use the advanced measurement approach for operational risk capital? A bank's risk measurement system should be sufficiently granular to capture the major drivers of risk affecting the shape of the tail of the loss estimates. That is correct. It is needed. Supervisors will require the bank to calculate its regulatory capital as the unexpected loss, disregarding the expected losses. I will come back to this after evaluating the other two options. Internally generated operational risk measures used for regulatory capital purposes must be based on a minimum 5-year observation period. When the bank first moves to the AMA, a 3-year window is acceptable. That is correct. The bank should track internal loss data is also correct. So A, C, D are definitely correct. Now the regulatory capital will be the expected loss, however not disregarding the expected losses. That's too strong a statement to make. So we will pay a regard to the expected losses also, and if the expected loss itself is too high, then we may want to keep an additional buffer, because you may not be able to recover everything from the pricing of your products. So we will pay regard to the expected loss as well. We'll now learn how we can keep a charge for market risk in Basel II. So in the standardized approach, as was done in Basel I, or rather even in Basel II, in the standardized approach, there's an arbitrary charge of 8% applied across asset classes. So generally speaking, the market risk for a bank comes from 5 broad asset classes. So there will be interest rate risk, generally measured by duration. There will be equity risk measured by beta. There will be currency risk to the extent the bank has foreign exchange or foreign currency exposures. There will be a commodity risk, depending on what kind of positions it's taken in various commodities across the world. And there can be an options risk. Now, in the standardized approach, the bank is required to calculate a market risk charge for each of these asset classes separately. So we take the total equity exposure, the total forex exposure, the total commodity exposure, the total option exposure, and the interest rate exposure, and we say 8% of each of these exposures needs to be kept as capital charge. So we will just compute the capital charge for each of the asset classes separately and sum it up to compute the capital charge or the market risk charge for the bank. So that's why I say an arbitrarily 8% charge is applied across classes. Hence it ignores diversification, because interest rate, equities, forex, commodities, and options obviously will not have a perfect correlation. So simply adding these risks is assuming a correlation of 1, or maybe an overestimation of the risk. But that is what you're required to do if you're unable to demonstrate sufficient risk management procedures on your own. So unsophisticated banks will have to use the standardized approach and calculate the market risk charge as depicted. The more advanced approach for calculating market risk that Basel allows is called the internal models approach. So in the internal models approach, we have to first satisfy some qualitative and quantitative requirements, and then we'll be allowed to use this approach. So there should be an independent risk control unit that is independent of trading and reports to the senior management directly. So this risk unit should have no link with the traders so there should be no conflict of interest between this risk unit and the actual trading department or the business line. There should be sufficient back testing done. So regularly back testing so as to validate the accuracy of the VAR calculations. Senior management and the board of directors need to be involved in the risk control process, because please remember, risk culture comes from the management. If the top management does not have a risk focus, the employees down the line will also definitely not have it. So the senior management definitely has to have a no tolerance policy and a very strict attitude towards risk management. The bank's internal risk model must be integrated with the day-to-day management. So this avoids situations where a bank could compute its VAR for regulatory purposes and otherwise ignore it. So depending on your VAR calculations, your traders need to change their positions. So if the VAR is too high, then you need to cut your trades, you need to reduce your exposure. If you're just calculating VAR for showing somebody, then it has no meaning. The bank should use risk management systems to set internal and external or basically exposure limits. Stress testing should be regularly done, as we studied with VAR. So the results of stress tests must be reviewed by the senior management and reflected in the policies and limits set. The bank should be compliant with the documented set of policies, and there should be an independent review of the trading units and the risk control unit. So if you satisfy all these qualitative criteria and certain other quantitative criteria with regards to the collection of data and the use of data, as we'll see, then you may be allowed to use the advanced measurement approach. So a horizon of 10 trading days or 2 calendar weeks, so in 2 weeks there are 10 trading days, is what is generally used for the VAR calculation. So remember, the VAR calculation has 2 basic inputs, or VAR is defined with the definition of a time horizon and confidence level. So what Basel II mandates is that the time horizon should be 10 trading days and the confidence level should be 99%. Observation period based on at least a year of historical data and updated at least once a quarter is required to be used in your risk models. So these are some quantitative requirements that you need to have before you can use the internal models approach. And then the market risk charge in the internal models approach is calculated as the higher of the previous day's VAR or K times the average of the last 60 days VARs. So whichever number is higher will be our VAR, either the previous day's VAR, and the VAR will be calculated using this entire yearly data or more, and it will be a 10-day VAR. However, the calculation done just yesterday, or the average of the last 60 such calculations multiplied by K, and we'll understand what this K is, plus a specific risk charge. The regulators can increase or decrease this depending on how much confidence they have in your systems, or depending on the specific risk that you as a bank carry. If there is more concentration in the portfolio, etc., then an additional specific risk charge may be levied. Please remember, when we studied back testing in market risk for FRM part 2, we studied that the results of the back testing are used by Basel to increase the risk factor K. So generally K is kept at a level of 3. Depending on how good the results of your back testing are and how many exceptions you find. So we saw that 0 to 3 exceptions, there was no increase to the risk charge. 3 to 7 K was increased by 1. So instead of 3 times this, you may need to keep 4 times this, or even 7 times this. So on and so forth, depending on how many exceptions or how good is the calculation of your war. If more exceptions are found, that means your war calculation is not very good. Hence this K will keep increasing. You can please go back in that section that is backtesting war and see what Basel prescribes about this K. But on an average, K is kept at a minimum of 3. We'll discuss a little more about this K in the coming slide. So the minimum value of K is 3. The specific risk charge, or the SRC, that is added at the end is to provide an additional buffer in the case of an event. And the 10-day war is allowed to be calculated from the 1-day war by multiplying by root 10. So that time aggregation Basel allows us to do. But please note that if a 10-day 99% war, for instance, is $100 million, what this means is that in 100 10-day periods, there will be at least one 10-day period in which the loss will be greater than 100 million. That is, in 1 out of these 1000 days, let's say the 1000 days I break up into 10 or 100 10-day periods. That means once in 1000 days, the loss will be greater than $100 million. Or you can say that even if you divide by 250 trading days in a year, then once in about, or 252, then we can say once in about 4 years, this war will be hit. So that's not a very good or a very rosy thing to hear. Hence the regulators say that this war will happen once in 3-4 years. Hence you must keep a buffer equal to K times this war, that is at least 3 times this war, so that this at least becomes 12 years if not more. So that's about the market risk charge as given by Basel II. Now Basel III had the biggest impact on the market risk charge calculation. It did have other implications also on other calculations. However, after the crisis in 2007, 2008, where we saw that the market risk calculations for all banks went significantly awry, there were huge losses, there was no liquidity, and whatever capital buffer was kept was abysmally insufficient, and there was a systemic crisis. So Basel III that came in 2009 focused extensively on the calculation of the market risk charge and the capital needed. So what Basel III did was, to our original calculation of Basel II, we added 2 more terms. So there was a stressed war, or a stress case war, and an incremental capital, or an incremental risk charge. The stress war calculation was exactly the same as our regular war calculation. That is, it is higher of the previous day's S war, or K times the average of the last 60 days S war. Whichever of these 2 terms is higher is what we will use as the stressed war. The difference, however, is that the time period or the data for the stressed war calculation must come from a stressed time. So this data, or this loss data, will not come from normal times, or this return data will not come from normal times. This will come from whatever the regulators agree on as a stressed time. So at any point it is assumed that we can go into stress, and when stress has happened, or when stress happens, then our last 1 year or last 1 good years of data may not be valid. So for calculating this war, we said that we need at least 1 year data which was updated quarterly. However, in 1 year, only good things may have happened. In fact, if we studied the data from 2002 to 2007, we could have never predicted what happened in 2008 if we used even last 5 years data as our base. or the war that would have come from using data from this period would have never been able to predict what happened in 2008. So to any year's war calculation or any period's war calculation, we further add a stress war wherein the war is calculated similarly, but this data must come from some stress time like 2008 or 1995, so on and so forth. We also add an incremental risk charge, which basically says that in bad times or in crisis, there is an incremental risk. Liquidity evaporates, the specific risk also evaporates, contagion happens, correlations increase. So an incremental risk charge to account for the lack of liquidity and the liquidity of your instruments, etc. So if you have more complicated instruments that you are dealing with, then again an incremental risk charge will be higher, so on and so forth. So Basel III added two new terms, the stressed war and the incremental risk charge. Once again, the multiplier Ks is subject to a floor of 3, like in a regular war calculation, and in addition a factor that depends on the results of backtesting in the war. So whatever factor we were adding to this K, we would similarly add to the K in the stressed war as well. For stress war, data comes over a stress time, for example 2007 and 2008. The amendment to the Capital Accord requires that internal models utilize at least 6 months of historical data, utilize at least 1 year of equally weighted historical data, utilize enough historical data so that the weighted average age of the data is at least 6 months, or utilize 2 years of historical data unequally weighted. The answer is the internal models must utilize at least 1 year of equally weighted historical data. Under the market risk amendment, a bank can use its internal models to calculate the market risk charge subject to all of the following provisions except time horizon of 10 trading days is needed, 99% confidence level is needed, 1 year of historical observations which are updated semi-annually is incorrect. It has to be updated quarterly. So this is incorrect, this is the right answer. Except is what the question asked. The market risk charge will be set at the higher of the previous day's war or the average war over the last 60 days scaled by a multiplicative factor. That is correct. So C is the right answer in this case. Which of the following best describes the quantitative parameters of the internal models approach? So once again, 10-day trading horizon, 99% confidence interval, minimum 1 year of data, and minimum quarterly updates is the correct answer. You are given that the risk matrix war for a portfolio is $1 million. What is the approximate Basel committee war? So please note that risk matrix uses a 95% 1-day war. That's something you'll have to just memorize and remember. It's a model given by Credit Suisse that uses a 95% 1-day war. So if the 95% 1-day war is given to be 1 million, then how much would be the 99% 10-day war? We will first convert this 1 day into 10 day, that is 1 multiplied by square root of t or square root of 10, and then we'll compute, or we'll change this 95% into 99%. So 95% means it was 1.645 into sigma, and for 99% we need 2.33 into sigma. So we'll divide by 1.645 and multiply it by 2.33 to get the 99% 10-day war, which comes out to be about $4.45 million. What would be the market risk capital requirement for a bank with an average 1-day war of 100 and a specific risk surcharge of 30 based on the current BIS minimum capital requirements. Please note, I'll change this question. It's not current. So current would be Basel 3. So we'll say based on Basel 2 minimum capital requirements. So pretty straightforward. It'll be the market risk charge or the VAR plus the specific risk charge. The 1-day VAR is given, so we'll change this into a 10-day VAR and then add the specific risk charge of 30. And please note, the average 1-day VAR is given. So if you're using the last 60-day average, then we have to also multiply it with K. The minimum value of K is said to be 3. Since nothing else is mentioned, we'll assume K to be equal to 3. So 3 into 100 into root 10 plus 30, which comes out to be $979. Which of the following statements is false regarding the calculation of the specific risk charge for the market risk capital rule? So the false statement is being asked. If the bank can demonstrate that its specific risk modeling captures all aspects of specific risk, a surcharge will not be required. That's incorrect. Surcharge will still be required. If a bank's model captures the idiosyncratic variation in its debt and equity portfolios, but does not measure default and event risk, a model calculated surcharge should be added to the capital charge. This is correct. Specific risk includes default and event risk, but not idiosyncratic variation. That is definitely incorrect. Specific risk is for idiosyncratic. Specific means idiosyncratic risk. So statement A, my apologies, was correct. That if the bank can demonstrate that its modeling captures all aspects, then a surcharge may not be required in the internal models approach. Specific risk is meant for idiosyncratic variations that will generally not be captured in the default and event risk. So this is incorrect. If a bank's model does not measure specific risk, then the surcharge for specific risk should be 100% of the standardized specific risk surcharge. So then whatever you are applying under the standardized approach is what you will apply as in the internal models approach as well. So statement D is also correct. Statement C is the incorrect statement.